welcome everybody. Let's talk real estate. Your weekly BS with Barry Saywitz about the current commercial real estate market here in Southern California. As we take a no BS look at both sides of the issues driving this market today to find the best solutions going forward. With our man right in the middle, it's Barry Saywitz. Hey, Barry.
Hey, good morning, Paul, and good morning to all of our viewers and our listeners out there. We're back again. It's Tuesday. I am Barry Saywitz, president of the Saywitz Company, managing partner of Saywitz Properties, and we are going to talk some real estate. Before we get going, I do want to do a shout out to all the football teams that won this past weekend. We are in peak playoff season, and so good luck to all the people again next week. But we're going to focus on some real estate stuff. We're going to talk money, maybe a little politics, and some juicy stuff along the way. I'm excited to have our guest, Ivo Tjan, who is the CEO and founder of CommerceWest Bank, one of Orange County's preeminent banks, in not only in the county but in the state. And so, Ivo, welcome to the show. Good to see you.
Thank you, Barry. Thank you for having me here.
Yeah, so it's been a while. I know that the bank is doing well and continuing to expand, and I want to go back, though. I want to talk about your history in Orange County because you've been around for a long time. The bank's been around for a long time. And let's go back to your days. I mean, you went to school here in Orange County, right, at Cal State Fullerton. You get out of school. It's a couple of years back now. And what makes you decide to get into the banking or the finance world?
When I got out of school, I actually got out of high school, and I told my father that I actually wanted to be a banker. He didn't like the idea when I first presented it to him, but his option was either, Ivo, you're going to go out and get a student loan like everybody else, go to college, come back 4 or 5 years and tell me what you want to be, or number 2, you're going to get out of the house. And I said, well, he didn't have any money. I didn't have any money. So what I decided to do was I went to school at night at Cal State Fullerton, and I went to work during the day at a bank. I started off in collections, teller, new accounts, branch manager, and so on and so on. I had a pretty big passion when it came to finance. I was very good at math. I could probably do most algebra in my head. And it fascinated me about math, and then fascinated me about business models, trying to tear through business models and reconstruct them and redo them. So it was just kind of a passion that I fell into that for some reason I knew I wanted to be in banking.
See, and I always thought, because at one point I wanted to become a banker because I like counting the money, and then I realized there was a lot more to it, and so I moved on to something else. But so you get out of school, you're in banking sort of already while you're going to school, and then you work for some other very large banks to sort of, I guess, learn the business and the industry, and then what was the epiphany? So 2001, you decide, hey, I'm going to start a bank, right? I mean. And if I remember correctly, this is around the time where it's the dot bomb. I mean, the economy is not completely chugging along. Things are not perfect. What was the aha moment, if there was one, where you said, hey, this is what I think I'm going to do?
So I was working at 3 or 4 major banks. I actually never left the bank. The bank left me through mergers and acquisitions during the 90s. The last bank I was at, I hinted at maybe being the president of that bank. And lo and behold, what I saw was the bank maybe going through another transaction or a sale. And at the time, I decided to be more of an entrepreneur. Again, it wasn't by design. Someone asked me a few years ago, hey, were you always dreaming to be a founder or a CEO of a company? That wasn't the case. It was something that I thought was fascinating, meant that I wanted to help businesses, primarily small and what we call small middle market companies that are between, we'll call it $5 million in revenue to $100 million in revenue, that I thought was the most underserved market in banking. Because I think in retail, consumer, mortgage, you kind of get everything from every other bank. But I thought as a small business owner, as a mid-sized business owner, you needed more creative financing. Even real estate individuals that are high net worth individuals that own these businesses needed more creative structuring. So what I thought was it'd be really cool to start a bank that dealt with entrepreneurs, business owners, real estate people, manufacturers, wholesalers, distributors, service companies. And then number 2, we customize and tailor make everything. So what we do differently than almost every other bank in the country is we don't have a rate sheet, we don't have a FICO-driven product, we don't have a matrix. We actually tailor make a loan product or a depository product for that specific client. which I think is unusual, right? If you're a $1 billion company, a $2 billion company, you're going to get that kind of service from a bank. But at CommerceWest Bank, we actually give you a tailor-made product for that small business owner. So my analogy, I'll kind of close it off this way, is I want to give you a tailor-made suit, Barry. And this tailor-made suit, you might turn around and say, Ivo, I don't want the tailor-made suit, but I give you one anyway. And you said, it does fit better. It's not as baggy. I like the material. I like the fit. And I tell you, I'm going to give you a tailor-made suit, but I'm going to price it the same as you buy it off of Macy's or Nordstrom's or anything like that. And that's kind of how we deliver the product. So that's how the bank started, was just the vision of saying, what's the most underserved community? Number two, how do we tailor make and create a difference with those clientele and expand the relationships?
And no better place really to do it than Orange County, because it's such a dynamic and diverse environment for business, where it's not just loaded up on lawyers and accountants and or manufacturing companies. You really do have a little bit of everything in Southern California, and Orange County in particular. And so you have companies that start out small and go off the chart, and you have other companies that have been around a while that continue to do well.
Yeah, we're very fortunate to be in Orange County. It's a well-diversified community. Our bank has what I call traditional businesses: manufacturers, wholesalers, distributors, service companies, professionals. We also, again, bank a lot of commercial real estate individuals, but family offices. But the ideology, I think, in Orange County is it very much is an entrepreneur, business-minded community.
Yeah, and so you're starting the bank, and this is the market that you go after. And that was really at a time, too, where there was still continued consolidation in the banking environment, where banks were either getting gobbled up or going under or merging or whatever the case was. And we've seen more of that as time has gone on. And now it's an interesting time as we fast forward, where we're dealing with a totally different environment that we've had from a lending standpoint, from a criteria, and also from a higher interest rate standpoint of people trying to get adjusted to sort of the new norm. And so as the bank has grown, have things changed in terms of the business model or the target market, or is it really just a question of dealing with the economy and the things that are going on and the challenges that businesses face today?
Yeah, our business model hasn't changed in 23 years, right? We just got named by Newsweek as one of America's best regional banks in the country for 2024, just a couple of weeks ago. And the business model is still the same. We still serve small and medium-sized businesses. We bank family offices. We bank the owners of the businesses. I think what's evolved and changed is there are less banks around, but more competition, as odd as that sounds. Even though the banking industry continues to consolidate, you have a lot of technology, fintech companies, and different competitors like that. You have a lot of foreign banks that are moving in, different type of lenders that are moving in that are non-bank lenders. So I think the industry has become more competitive in a lot of ways. Number two, I think everyone's trying to automate or standardize things, which I think still stay true to the core values of our bank, how we customize and tailor make things, differentiate CommerceWest a little bit more. Banks are trying to put everybody in a box, right? It's just the way of the future. In order to process a loan faster, for example, they try to fit you into a box in a matrix or a FICO-driven product. We don't do that, but I think that's going to be more and more of the future you're going to see. You're going to have to either fit in this FICO score or this FICO score, and this is the rate and terms you get. So I think that makes it an advantage for us, but it does create a lot more work for us because we have to actually get to know the borrowers and the individuals.
Yeah, and I've been told by many banks that I don't fit in their box, and I told them you just need a bigger box. That's all, right? And so it is a question of getting creative and then navigating what's going on in the world.
And I think most banks today, Barry, the reason you're seeing that experience is they create the supermarket model, right? They're trying to be all things to all people versus being all things to some people. So at CommerceWest, like I said, we serve businesses, owners, and key executives, and I think that's a differentiator. If you try to get into consumer loans and free checking accounts and home equity lines and Visa cards and MasterCards and all these other things in volume, I think you become more of a supermarket or a typical what I call B of A model.
Right. And so, in terms of, rewind for a little bit, there's all kinds of problems with First Republic, Silicon Valley Bank. Sort of gives a bad taste in a lot of people's perception of the regional banks. But really, I guess what's your take on it? To me, it was sort of isolated to a few banks, and they ran into problems in certain instances. It doesn't really apply to everybody out there.
No, let me focus on Silicon Valley because that was kind of the mothership that unloaded everything first. The problem with them is, I think people need to realize, it was a singular business model, a very large company, and they did it very well. But it was really an IT industry that they were focused 100% on. Something approximately like 43% of their businesses were venture capital. So let me explain VC for a lot of people that don't understand VC. You're talking about banking pre-revenue companies. You know how difficult it is to bank revenue-based companies that are actually generating revenues. So they focus 43% approximately on what I call pre-revenue companies. Well, that makes it a very challenging model. So I think their issue is they needed to diversify more. And again, maybe it's the fault a little bit of the management team, the regulators, but we don't. So we go after hundreds and hundreds of different industries, different types of manufacturers, wholesalers, distributors, and most banks typically do. But I think in their situation, it was just they were caught in that big storm where VC and investment were coming out of that technology industry. So I think that was really the catalyst of their issue.
Yeah, and then that transformed into First Republic and carried on, and you know,
it was like a wildfire.
Yeah,
right?
and
loss of confidence.
Right, and at First Republic, you had a lot of high net worth individuals that were banking with them, and so where do those folks go? I mean, is that opportunity for you today?
So we've actually had a pretty good windfall from First Republic. First Republic, some of their clients, a lot of their clients actually fit our clientele. They're business owners, they're entrepreneurs, things of that nature, real estate investors. But Silicon Valley, we didn't get really a backdraft from that. We don't typically go after technology-based or VC-based companies. We don't bank pre-revenue companies. That's not usually our forte. Silicon Valley did a really good job at it. But it's a whole different structure and understanding. It's an art more than it is a science. But,
yeah.
but
So I want to talk interest rates for a little bit. I mean, that's always the topic around the dinner table, or at least my dinner table, in terms of where they are now versus where they were 18 or 24 months ago, and then where everybody thinks that they're going to go. And so I'm curious your opinion. There's no question rates today, more than double what they were before they started taking off. And then that has an impact on both the residential market, on the commercial lending market, on businesses being able to borrow debt. I mean, it's across the board. Many of the people that I talk to are like, oh, rates are going to come down, right? And I'm curious as to your thoughts, if there's truth to that, and if so, if when, and if people's mindset is really all just wait because I think rates will come down.
Yeah. So I think as a bank CEO, we usually get different data points and maybe form our own perspective. So in my humble opinion, interest rates really is a function of the strength of the economy today, right? You got inflation, and then you have the strength of the economy. We believe that there are deflationary pressures that will continue to occur throughout 2024. There's no question. The deflationary pressures are here. You can see it on the PMI numbers. You can see it on the manufacturing side of it. I think where the challenge is going to be is I don't know if the Federal Reserve is going to lower interest rates as fast as most people anticipate, only because the consumers are still somewhat strong. Consumer spending, I should say, the behaviors are still strong. I think that's tied to a function of unemployment. So I believe unemployment is the Goldilocks that is the last piece of this economy that is the key to a soft landing. If unemployment stays, today's at 3.7, I believe, if it stays somewhere in that 3.7 to 4%, I think a soft landing scenario is very likely. If unemployment goes up 50 basis points from today and maybe stays closer to that 4.2 to 4.5%, I believe that you might see interest rates fall faster. So the reason that I think the Federal Reserve will hold on a little bit longer is because the unemployment rate is so low, consumer spending is still there, and I believe that will cause inflation to continue to decline, but maybe not at the fast pace. And one last thing I'll mention is this. I know people are looking at the deflationary numbers and the inflation rate, and they're saying, look, rates have to drop. I think the market has priced it in March to drop the first quarter. The only thing I would tell you is history has shown through the last 6 recessionary cycles that the Federal Reserve will pause and wait. What I mean by that is they're gonna probably want to see some seasoning, just because they see the inflation rate go down for 1 month or one quarter. They're probably going to see maybe 2 quarters, right, or something like that.
Yeah, and I agree with you. I don't think there's this all of a sudden drop. The problem is, I believe that a lot of people watch the news and watch the internet, and they believe what snippets that they hear. And if the short answer is rates are going to drop in the future, which they very well may, the question is by how much and when and to what degree and frequency, then they start acting accordingly. And so on the consumer side, if people are still working, they have money, they spend, they put money on their credit cards, even though it could be at 25 or 30% and they don't realize it, until they don't have a job, or they have less money, or they're not getting a big fat raise, and then they adjust their spending accordingly. And I agree with you. I don't think that's happened. And then the problem is, from a real estate perspective, it's very difficult to make a loan. It's very difficult to make a deal as an investor, because you have a disconnect between cap rate, interest rate, buyer's motivation, seller, and it causes basically a slowing of the transaction volume, which then also slows down the real estate world.
Yeah, you're going to see probably continuous credit tightening from the banks throughout 2024. That's going to slow real estate transactions a little bit more. You're going to see that, like you said, the financing rate today doesn't make sense for where the cap rates are. So that means two things have to materially occur. Either prices have to drop that cause that cap rate to move up, or you're going to see interest rates drop materially on loans. So it's like the horse before the cart, right?
Yeah.
Which one's going to happen first? I believe there are rate cuts that will occur in 2024. I'm not in the camp that I think you're going to see 4 or 6 rate cuts, coming down. I think it's possible to see 2 or 3 if I were, but I think you're seeing that in the second half of the year, maybe not the first half of the year, if you saw 2 or 3 rate cuts.
Yeah, and obviously we have an election year, so I don't know how that plays into the Fed. It's sort of two trains going by themselves, but the fact of the matter is, the better that the economy does overall, I think it benefits the current administration. And if there are continued struggles and people are continually not happy with what's going on with the economy, it'll be better for the other party.
So so you make a good point there. Technically, the Federal Reserve is independent. Right, they're independent in terms of their decision making of interest rates, quantitative tightening, quantitative easing. I think where you're going to see more pressure on inflation is the administration is going to spend approximately $2 or $3 trillion into infrastructure throughout 2024, and I think that has an ability maybe to create more inflationary pressure throughout 2024. So it goes back to our original conversation. Maybe rates don't go down as quickly as people forecast in 2024 for that reason.
Yeah, it'll be interesting to see how it plays out. And then the other piece of it is how the stock market does or doesn't do, and whether it's continuing to be very volatile because people have money tied up in that, and then they look at their balance sheet based on what happens, and it's very difficult to predict.
Yeah. And it'll be hard, I think, to see interest rates where they were, we'll call it 3 or 4 years ago.
I mean, I think that ship sailed. I'm curious your thoughts, but I mean, I'd be happy with 5.
Yeah, I think the zero free money, we'll call it, right, that 1% interest rate, it may not exist again unless we see, I don't want to say a global financial crisis like we saw during 2007 through 2009, but you're going to have to see a pretty big recession occur before I think the Federal Reserve decides to pour the quantitative easing and then lower rates back down to 0. So I think you're right. I think the likelihood of that scenario is very low.
And relative to Orange County, I mean, it's still a very desirable place to live, still a very expensive place to live, and still a challenge in terms of providing affordable housing across the board. There's just not cheap housing here. And so we've had mayors from other cities come on and economists come on and talk about where they see the housing market and how that fits into the overall economy as well. Do you think that that's one of the driving factors to watch, is that if people can't really afford to live, then they either need a raise, you have to pay them more as an employer, or they'll have to commute from someplace else?
Yeah, so the single-family residence market, to me, is bifurcated from commercial real estate. Usually they act differently, right? So we still see a strong housing market, only in the simple sense that, the stat is somewhere like 80-something% of home loans still have a 3 handle on their mortgages. Yeah. So I think that stays good, meaning if people couldn't afford their homes, they probably have the ability to rent out the property and actually have a surplus in excess, right, every single time. So when we look at single-family residence, I think the biggest obstacle for housing is the down payment issue. I've spoken this to many Congress members that I said, look, the issue is not that people can't afford in Orange County the payments. So when you look at these multifamilies that you're seeing the Irvine Company build out or near John Wayne Airport, I mean, some of those rents are $3,000, $4,000, $5,000, $6,000 a month. So obviously they can make the mortgage payment. I think the issue is the down payment. So if you remember, when I bought my first house, it was a practical impossibility to get the down payment, right? And they had different programs. You could put down 3%, 5%, whatever the case was. And I think rolling equity is the key. So I think what fundamentally, again, not to get into too much detail, but the structural issue, I think, is we need to find a way for people to get into a house, because once they're in the house, the equity builds, and then you can roll and roll and roll like most people in California do. That's why the hardest thing is when you get out of California and you move to Texas, which I'm not saying is not a great state, to get back into the real estate market in California. Good luck. I mean, real estate
the
grows
barrier
1
to
or
entry
2%.
is just too difficult. Yeah, of course.
So you just keep getting outpaced every single year. So I think that's the bigger issue is how do you get people into housing? Because the payments, when you do the math, is about the same as rent, right? I mean, you're paying $5,000 a month. You can pay $5,000 a month on a mortgage.
Right, which is exactly what happened in markets like Phoenix or even out in parts of Riverside County where the rent got so expensive, people just go, I can just buy the house. But if I don't have the credit, I don't have the down payment, or I can't qualify based on whatever the underwriting is, then that makes it a challenge. And then I continue to rent and keep chugging along.
Yeah.
So, yeah, and I think that the housing market, to me, the supply-demand dynamic, there still is low supply. So that's why you're seeing prices not really coming down, even though the rates are higher. And it'll be interesting to see if that changes or if it just stays with really low inventory, because especially in Orange County, really not building a lot of stuff.
No, and that's why building permits, if you look at it, are still up nationwide and in Orange County. So the new home builders have done well. Their stock has done well throughout the year, even though people thought in 2023 it was going to crash, is because the demand for housing is there. Right. It's just, so I think there's, I mean, I'm not saying we can't create a better affordability index. That's not what I'm saying. I'm just saying at the end, the structural issues, how do you get people into a house that are both, let's say a husband and wife are both making good money, but they just can't come up with the down payment. You know how difficult that is. Your first house, that down payment to save $200,000 or $100,000 or whatever it is you need, that's a lot of money. Even if you're making $100,000, even if you're each making $100,000 pre-tax.
Right, and the 80-10-10 loan doesn't exist.
And they used to have the 5% loan.
Right,
remember, that's how I got in.
Right. And so it pays to sign up for the military. You get the VA loan and come up with 3%. And so, I think that really will continue to be the challenge. And then that sort of feeds to the multifamily market, which is, people buy apartments in Orange County as an investor and pay ridiculous numbers with very minimalistic returns because they just perceive, I guess, that it's a good piece of property, it's a good location owned property, and long term it'll probably go up, which makes it difficult for guys like you and me, because it makes it difficult for you to loan on that deal without a very large down payment and some skin in the game, and makes it difficult for a guy like me who's actually trying to get a return on his money.
Yeah, I think multifamily will continue to be tight over the next 2 or 3 years. I think the more interesting space to watch is commercial real estate in the office segment.
Yeah.
Right. I think the office segment is a debate that everyone's been having, and this is kind of my viewpoint on it. I think office historically acts in it follows unemployment. So typically when unemployment goes up, office vacancy goes up. I believe this time it's different. I believe it's the inverse relationship. So I think one of the things for office people that own office buildings out there is I think the higher unemployment is, the less options that the employees have compared to today, and the more that they drive employees back into the office. So I think the interesting thing is that office space is an inflection point, right? I mean, you're talking about a lot of office buildings today that are at replacement costs, right? It's almost like buying a house during the global financial crisis, where all these residential homes were all at replacement costs. I used to tell people all the time, up in LA, Orange County, Inland Empire, Riverside, San Bernardino, I said, look, buy every house you can in 2011 and 12 and 13. Everyone's like, Ivo, what are you smoking here? What's going on? I said, look, if the house is at replacement cost, you just burn the house down and then the insurance will pay you for it. So I can't imagine that the house can get any cheaper. Office is kind of in that same inflection point. And everyone's saying it's a new economy, a new world. I'm just saying, I think it's a function of unemployment. With unemployment being as low as it is, The put option is really with the employees, and
Right.
it's not an equal balance like it typically is with the employer and employee relationship. So I think you're going to see that as unemployment rises, which I believe it rises. I don't know if it gets to 4.5% or 5%, but I think it continues to rise over the next 2 years. I think that bodes well for offices.
Yeah, no, I don't disagree. And then you have a combination of the fact that, one, there's really no new construction, so there's no new product. And then number two, you have some of these older, antiquated office buildings really either getting reused or torn down, and it's not the highest and best use. So you're going to multifamily, or you're going to medical, or you're going to something else other than office, even industrial, right?
Yeah.
I mean, industrial rents today in Orange County, on a net basis, it's a better return than trying to rent office space in Newport Beach. I mean, it's a crazy, crazy scenario. And so the other thing that I think will be interesting is if people are not coming back to work, then as these leases roll over the next couple of years, you will have companies continue to look at downsizing, resizing the space that they think that they need if they really believe their employees are not going to come back. But we talk to a lot of clients and business owners that say, hey, look, I'm going to keep the space because I still believe there's a day where I just might need it. And I'm curious what your clients are saying from a standpoint. I think, look, for me as a business owner, I want to get back to the point where the owner's in control of his own destiny. I'm not sure that that's 100% there today.
Yeah, a lot of our clients that are employers believe that it is more there is more productivity and synergy, learning, collaboration when you have the employees in the building. I think a lot of employers and business owners, though, are trying to be more productive and efficient. So I think they are trying to use the office space a little bit differently. Number two, I think there are positions, if you take 100% of people that are in office, that 10 or 15% probably stays out forever. So there's like sales position would be the easiest.
Right.
There's an argument for some sales position that could probably be out there. They're supposed to be out there anyway.
Right, I don't want you here anyway. You should be out selling.
So I think those might be more permanent, or maybe they go into a hybrid situation. But if you look at the vacancy, I mean, it's been improving in almost every major city throughout the U.S. over the last 2 or 3 years. COVID will have a lingering effect. So I think, like everything else in America, we'll have amnesia one day, right? It's almost like with credit cards and all these things. So I do believe that people want to interact, people want to collaborate, but I think they have to have a need or a want. So for us, as an example, we have 100% of our, almost 100% of our people back in the office, but we did it early during COVID, and we incentivize our employees. So how do we do that? We started offering free haircuts. We brought in barbers and hairstylists. We brought in manicurists and pedicurists. So when employees call and say, hey, I can't even get a manicure, I said, yes, you can. I said, you can go in the back and in the parking lot. There's a bunch of tents back there. And we brought in lunches with food carts everywhere, right? I saw it at Shark Tank, this lobster food truck. So I said, hey, get that lobster food truck from Santa Monica, and then call every restaurant you can find in Orange County, LA County, or San Diego County, Riverside County that has a food truck that's still operating. Bring a different food truck every week. So employees would call and say, Ivo, I can't even go to a restaurant. I said, we're having Japanese food this week. I said, you can go grab lunch, right, and then you can go, grab some for dinner if you want. And the next week we're having Mexican food. And the next week after that we're having Brazilian food, and so on and so on. So I think there was a reason for people to come in. And once they came in and felt comfortable, I think the interaction kind of takes over on itself. People do like to interact, but I think employers forcing the issue is the wrong approach. I think trying to force them to say, hey, you got to show up, instead of incentivizing them to show up. So I think there's going to be different tactical things like that as people try to bring people back in the office. You can tell that the hard-handed approach that I think Goldman and JP Morgan tried to take originally is saying, hey, you're showing up, it didn't work.
Right, well, because there's still somebody else who might hire them and let them work from home. And so because the market's still tight, you have a little more leeway to go shop around. But I think the days of, hey, I want a 40% raise or I'm going to leave, those have slowed down.
Yes.
And then people hopefully are a little more realistic. My whole thing is you have these dynamics in the economy that are real, that are going on, and you have metrics that you can watch, but then you also have people's perception, right? And then that tends to dictate what happens going forward. So with that said, we only have a couple of minutes left. I told you to go quick. We could talk all day. But where do you see it going in at least for the next 12 months for 2024, in terms of the lending environment? Is it going to stay the same? Is it going to be a challenge? And then how does that play into the various aspects of the commercial real estate world?
Yeah, so let me mention three things. One is that we see 2024 possibly setting up to be a more challenging operating environment than 2023. Only because even if it doesn't go into a recession, we think that going from a 3 or 4 GDP to a 1 or 2 will feel like you're in a recession, even if you don't go into negative GDP. So that's one. So I think it'll be a rougher operating environment for everyone. Number two, look, commercial real estate has to normalize, meaning that the credit delinquency and loan defaults haven't been there the last 2.5 years. I believe the normalization of commercial real estate defaults and delinquencies start occurring. Same with auto loans, same with credit cards. All those things are, I think we're seeing it at least starting to occur in 2024. So that might feel hurtful for the banks, might feel hurtful for the economy, and hopefully it doesn't get worse than just normalization, doesn't get past that. The third part is this, look, credit's going to tighten. For everyone that has commercial real estate, I will tell you, one of the most important things is get to know your banks and your lenders. Form a real relationship behind it, because as much as we want 2024 to be sort of an optimal year for commercial real estate, I think the market still tightens and underwriting still tightens. I think that will be true with regulators as they're dealing with liquidity and the issues they saw with Silicon Valley. I think it'll be an issue with some banks that have these huge unrealized losses in their bond portfolio. So I think on the last third point there is, I think the credit market tightens. I think relationships go back to what they used to be, meaning I think for a while it was very transactional. You could have gotten a real estate loan anywhere. I think it becomes the story now.
Right,
Hey,
the person.
Hey, Ivo, let me talk to you about this deal, why it makes sense, why you want to refi it, why I want to buy this office. We just did an office building where we were looking at this transaction. They got turned down at Wells a couple times. They came back to us and we looked at it. It goes, look, here's the deal structure of how it works. It goes, I went to 4 banks. It's a high-profile individual in Orange County. I went to 4 banks. They all just said no, didn't give me a reason. You actually gave me an option. If you want to finance it, it has to look like this, because I appreciate that. So I think it comes down back to that for the next year or two, but especially in 2024.
And you think it gets harder for the average borrower who was just going to buy their first property or an individual property to tell that story, because it really then just becomes the transaction, and there's fewer players and fewer options out there.
Yeah, you want to play that transaction game when the economy is fine or things are hot in the real estate market, maybe like they were 4 years, 5 years ago. I think it becomes less transactional over the next 2 or 3 year horizon, and it becomes more relationship based.
Yeah.
It's just, you've been around the
I
industry.
agree.
You know how that was. It's just, and I think people hopefully will remember that going forward in the future. I think the relationship does matter, especially for commercial real estate borrowers, different than single family. I think on the housing side, just to be clear, that's I'll call it a government program that is regulated, which if you look at it, for the most part, there's 30-year mortgages. I mean, go back to your bank today, Barry, and say, hey, can I have a 26.5-year mortgage?
Right.
They'll be like, what? Can I have a 2.5-year? Can I have a in the commercial real estate side? It's not regulated the same way. It's not one product has to fit everybody. So I think the relationship will matter a lot more than it will on single family. So if you own a house, I don't think you need to worry about going to CommerceWest or B of A or Wells Fargo.
No, you can go on the internet and shop it.
You can go on the internet and go shop it, because again, it's a regulated program of a 15 or a 30-year or an ARM program. But I think on the commercial real estate, the next 2 or 3 years, I would caution everybody to say, look, it's going to be a little bit of rough water. I know everyone's optimistic. You want to be optimistic. Orange County is an amazing place to live, amazing real estate. You know that for years. But you're going to have to look at things long term. It's not a short term thing with commercial real estate. You're going to have to slug it out for the next year or 2 or maybe 3.
And do you think that it makes sense to buy something even though the dynamics aren't there today because of the long term, or do you really wait for the adjustments that might be coming? That really is the difference.
I would tell you, in 30 years of doing commercial real estate loans, that there's always an opportunity. It's just in a cycle like this, the opportunities are more narrow than they would be in a normal cycle. Sometimes I will, just looking at our clients, our thousands of clients, what I've learned from them is they were able to buy some of the best real estate transactions during higher interest rate cycles when transactions were lower, because there wasn't as much competition and you weren't doing things,
right. You weren't overbidding and
you
getting
weren't
a bidding
overbidding.
war. And...
But I think the key is, this, look, when you take a loan, like the example would be if you take a loan today and you found this great piece of real estate, even though the cap rates don't make sense, you got to invest a little bit of money, you take a floating rate. And I always tell people, look, do the opposite of what everybody else does. Everyone keeps asking me, hey, Ivo, can you do a 5-year, a 10-year fix? I want a 20-year fix commercial real estate loan. I go like, no, you should take fully floating. They're like, why is that? Well, do you believe rates are going down? They're like, yeah, we do. Look, you might think it's 6 rate decrease. I might think it's 2 or 3 at most. But here's the thing. We both agree it's going down, right? Why would you get a fixed rate loan? Because when you're paying a fixed rate loan, you're paying for the forward curve. You're paying a higher rate. If you're paying for floating, you want to ride the interest rate down.
Right.
Buy this great piece of real estate. When it goes down 2 or 3 years, you come back to me, and then you fix it, and you could take a little cash out or do whatever you need, but you end up with a better real estate product riding the rate down. So structurally, it's important to structure the loan properly, but obviously the other 50% is finding the right real estate. So I think you keep looking, but it's going to be a lot more narrow. It's going to open up in 25 and 26, but before everybody jumps in 26, 27, 28, Barry, I would tell you, you got to nibble a little bit, but you got to be smart. And you got to keep your ears on the ground there and make sure that you're hearing about the right deals. And then 2, don't worry about the deal. You're like, well, at this rate, we'll call it 6.5%, 7%. You're like, Ivo, it doesn't really make a lot of sense. It makes only a little bit of sense. And I would tell you, well, if that rate was 4.5, would it make? Oh, it would make a lot. Great. Get a floating rate, write it down, but you'll be able to buy that transaction while it appreciates 10% every year for the next 3 years, and you'll thank me. And that's the advice I've given people for 30 years on real estate, the same thing on these cycles.
So what I'm hearing is be smart, buy low, sell high, right? Try and stay out of trouble.
Harder said than done, but yes.
Watch out for number 1, don't step in number 2.
And the deal loan structure is important. On top of finding the real estate itself.
And the relationship with your bank or whoever banks that you have. You're going to need those going forward. There's no question.
I think the relationship everybody wants to strengthen more over the next 3 years. It's going to be a little bit of a slug. I don't think it's going to be a straight upward or straight downward decline, but I think it'll just be one of these for a little bit.
Yeah. So how can people find out more about CommerceWest Bank in terms of the website and locating you and the folks at the bank?
Yeah. If you want to contact CommerceWest Bank, our website is www.cwbk.com. You're more than welcome to call us at 949-251-6959, and I'll even give you my personal email. It's itjan, ITJAN at cwbk.com if you have any questions.
Perfect. Well, I appreciate you coming on the show and sharing your thoughts as always. And best of luck to you and your family and the bank in the coming year, and appreciate your thoughts today.
Thank you, Barry. Appreciate you having me here, and wish you the best for 2024.
Great. So I am Barry Saywitz. This is Tuesday. We are talking real estate. Tune in next week. We'll be back. Thanks again to everybody here at OC Talk Radio, as always, for putting the show on, and we'll see you back next week. Thanks again.
Well, there you have it. You've been listening to Let's Talk Real Estate, your weekly BS with Barry Saywitz about the current state of the real commercial real estate market right here in Southern California. On Orange County's only community radio station, OC Talk Radio, streaming live from our studio here at the University of California, Irvine's Beale Applied Innovation Center.